So, this pullback that we've seen, this after-hours plunge from Meta, which seems to be dominating things today, is that it? Is AI over?
Well, I like what you've been saying. I think it's still too early to say, and let's remember that that stock was up over 40% year to date. And so I think overall, the earnings that we've seen so far, there's been a lot more good than bad. And I think what people miss is that this is the first quarter where we're actually going into growth again. So we've had an earnings recession the last 4 quarters, and I think overall, we expect a positive momentum in earnings this quarter to continue throughout the year, which we think can drive the equity market higher. Now, I think a lot of the gains have happened, and so this pullback we've seen, 4 or 5%, I think gives investors another chance to step in and add to equities a bit.
Well, it does seem like all the bears have been rolling out of bed the last few days and sort of giving us harsh warnings that we were due for a correction all along and so on. But that's not how you guys see it over at JPMorgan Private Wealth. You see actually upside from here.
Yeah, we started the year pretty balanced. We actually saw upside both in equity and fixed income, and I think the world was very much focused on fixed income given yields. And in the multi-asset portfolios, equities have driven the year-to-date returns. I think at these point today, we actually still see upside, obviously, in fixed income given where rates are. But with equities pulling back, we do think there's another 4 or 5% upside from now until the year end. However, we want to be more focused on different geographies, different sectors. A lot of people talking about the bubble, technology, but if you actually look year to date, technology as a sector is lagging the broader market. And so we do think what we're seeing, this consolidation, is actually healthy because the market's focusing on earnings, free cash flow, and valuation, and that's exactly the sort of stocks that we want to invest in.
So can you narrow that a little bit more down for us? When you say geographies and different sectors of the market, what do you mean?
We like the U.S., but we're now neutral, and we actually see a little bit more upside in Europe. And I know that's a bit controversial, but the valuations look good. We think there's going to be cuts coming from the ECB, and there's a lot of good multinational companies in Europe that we think will benefit from what is still pretty solid global economic growth. Within the U.S., very positive on healthcare. Lots happening in the drug discovery space, and healthcare also offers relatively attractive valuations, trading much cheaper than other sectors. And year to date, the sector actually is underperforming. So I think that's a good combination to outperform.
So is that one specific sector, or is this more of a growth to value pivot trade?
Yeah, I wouldn't say growth to value because I think there's a lot of good growth in healthcare that's not particularly expensive. And there's also a lot of good growth in technology that's not overvalued. I think everyone's focusing on a couple of AI stocks. But if you look, 4% of U.S. companies are even sort of adopting AI. And so there's a lot more to come in AI. Not just on the enabler side, it's the companies actually producing AI, but the adopters as well. And so we think about AI, we want to take a much more diversified approach and actually look for companies that will benefit, that actually have good free cash flow and good earnings today, and do it, I would say, in a much more balanced, higher quality way than just buying the high-flying early adopters that might be trading at high multiples.
Julian Emanuel of Evercore ISI makes that point as well, that AI hasn't gone away or anything. It's just that you need to find the revolutionaries.
Yeah, you need to find the revolutions, and you need to take a long-term approach and be very thoughtful about it. And don't just over-diversify in the hot company of today, because as we can see, that can very much change quarter to quarter.
The whole market seems to have been depending on NVIDIA. I do want to ask you, though, what it would take for your bull case to come to pass. Because you say, for now, you're looking for about a 5% upside from here for the S&P 500. But in the best-case scenario, you're seeing 5,600.
Yeah, that's quite simple. It would just mean that inflation comes down, the Fed actually does cut interest rate this year, perhaps more than 2 times, and geopolitics calm down here in the region. I think that combination could lead to a nice recovery both in equities but also in fixed income as rates would come down in that scenario.
So 60-40 still, or would you shift that a little bit?
60-40 all the way. I mean, we think this is the year to be balanced, and the good news is you can get good upside both in fixed income and in equities, and we haven't had that for some time. And so we do think 60-40 is a good starting point, and that's where we're guiding our clients.
Stephen, all of these geopolitical risks are in the background as well, and it does feel like the market prices them out real fast, but it can price them in real fast as well. Are your clients asking you about this?
Of course, because we're dealing with clients here in the region, and we're trying to, our job is to keep them focused on their goals-based plan. So what do they want out of their portfolio, not just this year, but really for generations to come? And that's hard, and that's what we do every day, is to talk to them and walk them through what are the risks, how the risks change. But you're right, the market really hasn't priced that in because the market's more focused on global economies, inflation, all of which I think is generally moving in the right direction. But we're watching it very closely. Geopolitics shouldn't keep you out of the markets. You should be aware, you should understand the risks, but you should use the volatility to your advantage and take advantage of that when you get it. And I think we're getting a little bit of that just over the last few weeks with the pullback.
We're just at the beginning of a mammoth earnings season.
Yeah.
What are you looking for in terms of share buybacks, capital return plans?
Yeah, I think strength in the U.S. consumer, I think is going to be evident. And we saw that just overnight with other companies that are reported. I think buybacks will be interesting to see which companies see value in their shares. Free cash flow still looks quite good. And so I think overall, the earnings picture in aggregate is going to look good. Of course, there's going to be some disappointments, less so on the quarters that were reported, but more just, companies are giving a bit more of a cautious outlook.
Yeah,
and
forecast.
when the market was up so much, like it needed to be perfect, and that's not happening.